European debt woes hitting the market again today. The yield on the 10-year Irish government bond climbing to another record high at 7.94%. Gold also soaring to a new record at $424 an ounce midday. Now, the EU's Commissioner of Economic and Monetary Affairs, he says he has no doubts Ireland will overcome its debt crisis, but the market not so convinced. So who is right? Let's turn to an economist who's worked on sovereign debt restructuring over at the IMF and also at the U.S. Treasury. He's Mark Dow, now a portfolio manager at Pharo Management, a hedge fund right here in New York City. Good to have you back with us.
Thanks.
We love having you on. So who is right here?
I think there's no definitive answer to the Irish question, which is the one in the front burner for most people.
And should it be on the front burner at this point?
Well, I think the Irish definitely have to focus on it because there's a lot of risk. They've got bad growth, they've got high debt, and they have a banking system that's still working their way through some very serious problems. So they have to focus on it. And at the European level, they have to make sure that there's no contagion, right? That this thing stays under control. We talked last time, or one of the times before, about how the strategy in Europe is to build a firewall and then eventually restructure the Greek debt. And in the meantime, they have to reestablish fiscal credibility in the southern countries and fix the banking issues in several countries.
What about a restructuring for Ireland? I mean, are the two situations so similar that you could basically interchange the names of the countries?
No, they're not. They're very different. But the point I was trying to make is that at the European Union level, you have to do everything you can at this point to make sure restructuring doesn't take place because the system is not yet ready for it.
To make sure restructuring doesn't take place. But we have seen German banks, at least, take precautions for when that day does come, right? Yep. They've broken up into good bank, bad bank, and shifted those sovereign debt assets into the bad bank.
That's correct. They're building that firewall, right? So one of the things is to fix the problems in the banking sector, and the German banks are taking steps towards that. The Irish banks have a ways to go, and then the countries in the south have to rebuild fiscal credibility. They have to get on a program and prove that they can stick to it, and we're just not there yet.
So once this firewall is in place, and let's say Ireland still needs help, does the EU basically said, we're protected, we don't care?
Yeah, my guess is that to get to the point where the firewall is built, Ireland will have to be resolved, probably in a positive way, right? It would have to be. And the country that is unambiguous in its need for debt restructuring, in my mind, is Greece. Ireland can go either way. Portugal can go either way. It really depends on how investors react to what the Irish do and to what the Irish do. It could be they could work their way out of the problem, or it could end tragically, right? And it really depends on what the Irish do and how much confidence people have in the measures that they take.
But isn't working their way out of the problem, isn't one of the options there for the debt holders to take a haircut, essentially restructuring the debt? I mean, is that what's going to happen for the Irish banks?
If that happens before investors are confident that the rest of the European system can withstand it, and the country we think most about is Spain because of its size, not because it's most at risk, but because it's kind of a cornerstone to the countries at the margin there.
As a result of an Irish restructuring.
Right. Because often the reaction in markets when someone restructures is, who's next?
Right.
Well, and I think about Spain. Mark Grant pointed out about, in terms of Spain, wasn't it the Russian sovereign or central banker that basically said we don't want to have anything to do with it? At this point,
I didn't hear that piece of news, but what you can clearly see in the spreads of a lot of these countries are investors who previously thought they were taking duration risk, interest rate risk, convexity risk, now saying, I'm taking credit risk, I'm not paid for this, I want out. So you're seeing a change in the structure of the investor base for this debt, and this is part of the reason these countries have been under pressure towards the end of the year. They want to clean up their balance sheets so they can say they're no longer involved with these countries when the new year comes around.
I mean, are there going to be implications for the U.S. markets at some point because of what's going on in Europe?
Potentially, but not yet.
Or for the European markets. I mean, they just hit a 2-year high yesterday, right?
It would have to increase to a higher level. The tension would have to increase to a higher level before we get to that point.
Can we get there, though, in your view, realistically?
I don't think so. I don't think we can right now.
Right now, but I mean, could we then at the end of the year?
Anything is possible, right? Because it depends on investor behavior. I don't think it's likely by the end of the year. Things could get a little bit worse, but I don't think we spill over to the point where we have systemic risk. Part of the reason investors are so nervous when they see the bad price action right now in European spreads is because they're looking at things through the prism of the most recent event, which was April and May. And we have a tendency to overstate the parallels in the first instance and then over time start to see the differences.
Although Ireland sincerely needs cash right now, right? I mean, we talked to Mark Grant from Southwest Securities about this a lot. He's watching it all the time, and he told us, I think yesterday on this show, that they have about 60 days left worth of cash. That's
a little more than that.
That just barely puts you at the end of this year.
They've got about $20 billion in cash on hand, then another $15 billion that they can access through a sovereign wealth fund, right? They're also, the banks are getting ample repos, access to repos through the ECB. So most calculations suggest that they could go to the end of the second quarter of 2011 without a problem. They might not want to. They might want to access the markets before then, but they could go that far if need be. And as I say, if you're in the European Union, you don't want to see Ireland get out of control until the firewall is built. And we're just not there yet. So they have to do everything they can to make sure that Ireland is given space to work through their problems.
On the other hand, if you're in the European Union, you increasingly don't want Ireland or any of these other countries, for that matter, to access this $1 trillion rescue plan that they put together, right? Because more and more governments, I mean, especially Germany, are talking about the bondholders need to take a hit here as well.
Yeah, well, that mechanism is envisaged for the successor to the EFSF, right? So the current mechanism doesn't envisage a haircut for the bondholders. But yes, you're right that it's not advisable right now for countries to avail themselves of that mechanism because of the signal it might send to investors about what might happen to the other countries, right? So they have to make sure that Ireland is given a space. But if you look at the balance sheet of Ireland and the cash flow situation in Ireland, they don't have to avail themselves of that mechanism now. Right?
Not quite yet.
And not maybe until the second trimester of next year. And who knows what happens between now and then? It may well be that the markets change and they feel more confident about the outcome of things. And so it's very context specific.
So what would have to happen, Mark, whether it's Ireland, Spain, Portugal, that makes you kind of change your view here and say, well, maybe things are spinning out of control? The firewalls are not going to be in place soon enough.
You would have to see a run of deposits or something along those lines in Ireland. Now, the deposits are insured, right? But some people are worried about them because they're linked to the senior debt of the banks. So that would have to happen. We haven't seen any signs of that yet.
But if there's more talk of the debt holders taking some kind of hit, could that happen?
If the Europeans backed away from that today to some degree, they wanted to make it clear that that's for the future mechanism, not the current mechanism, right? So I think that what they're trying to tell us with this new mechanism is once we get this fixed, we want to make sure it never happens again. So we're going to set up a new structure that has better incentives for the investors and for the borrowers.
So what happens at G20?
I don't think this is going to be a big issue at the G20. It hasn't risen to that level yet. I think there are bigger things that have to be dealt with.
What about for the equity markets? And we only have about 20 seconds left, but you know, we see the equity markets doing so well here, and even in Europe. Why do they seem to just ignore this?
I think it hasn't risen to that level yet. A lot of this is the technical selling of people who, as I said, didn't take credit risk. They were high quality government bonds who found themselves in a situation of taking credit risk that they don't want, and they've been shedding themselves of it little by little. 80% of the bonds issued by the Irish Republic are held outside of Ireland. And these people don't want to hang on to them. So I think that's it. Plus the memory of May and April is scaring people probably a little bit more than it should.
All right, got it. Mark, as always, thank you. We appreciate it. Mark Dow, everybody.